This is the Capital Economics. I am Alex Kreitis, and welcome to another presentation. This one is titled Monetary Measures. This is going to be part 2 of our series. Last week, we submitted another Capital Economics presentation where we were looking at the Federal Reserve's balance sheet, M1 and M2 money stock. Today, we're going to continue that conversation with the Fed's balance sheet, M1 money stock, and how this relates to some broader market measures, just so we can see the effect of some of this monetary policy that has been making its way into the system. So this is really going to allow the audience to see what I talk about on a daily basis within our podcast at the Capital News. So that's the purpose of Capital Economics, is to actually provide the visual to the audience of those who listen during the Capital News podcast. So just one thing I want to mention before we get started here, the Federal Reserve has updated M1 and M2 money stock. They have changed the definitions. They have discontinued some of those data sets and have recreated other ones. So this is almost apples to oranges now, so I'm going to have to recalculate some of these things. But this is what the Federal Reserve seems to do. It likes to do it. It is moving the goalposts, if you will. There used to be the broadest measure known as M3. Well, that data set was discontinued during the Great Financial Crisis and after the Federal Reserve started to implement quantitative easing, because that was something that was never conducted before, and obviously the broadest measure would have just been going through the roof. So they've discontinued it, and it's really never mentioned again. So it appears that they are on track to doing a similar act with respect to M1 and M2. But nonetheless, we're going to continue to monitor this, continue to have a weekly conversation about the Fed's balance sheet, M1 and M2, where they currently stand on our weekly podcast, typically on a Thursday, with respect to the Capital News podcast. So let's get started just to see what we're talking about here. So this first chart that we're looking at is M1 money stock versus the Wilshire 5000 index. Okay, we're going to look at this on the index basis. The price index will be the next slide, and then also the same thing, the Wilshire 5000 against the Fed's balance sheet. And what you're going to notice is obviously this really tight relationship, especially now, with respect to M1 money stock and how this broader measure of the stock market is moving in tandem. It's a tight correlation. It's a very strong relationship. This is not organic economic growth. This is liquidity being thrown into the system. I mean, you can look at this maybe, because we have M1 as our white line here and the Wilshire 5000 as the black line. And, not that this is how it works, but you can almost look at this from a technical standpoint and just note how well the Wilshire 5000 tracks M1 money supply. It goes above it here in 2000. This is sort of your dot-com era. Comes back below it, wants to get back to it. Here's your housing crisis, the great financial crisis. Drops below it, and then it likes to trend. It likes to get back against M1. Gets above it, comes back to it. Gets above it, comes back to it. And now it's basically a neck-and-neck race to the stratosphere. Because, again, this is not economic growth. This is not organic economic growth. Is there some organic growth within the economy? Absolutely. This is a very large economy in the United States, and of course globally. It is a very large global economy. So yes, there is organic growth, but organic growth is not driving these types of moves with respect to prices and valuations that we are witnessing in the stock market and in other markets for that respect too, especially in the bond market, because that's where a lot of this manipulation is taking place when you have one central bank after the next going in to their respective bond markets and buying up bonds, notes, bills across the curve. So the next slide is basically the same thing, but with the price index, so we can actually see the level as opposed to just a percentage move. And it's the same song and dance. We have M1 again here at about $7 trillion. This was before, of course, the Federal Reserve changed the definition of M1. They are now including savings accounts and money market mutual funds. So this number now is, I think, about $18 trillion. So it's just a huge difference, basically tripled it just because they changed the definition of it. And of course, to graph the new M1 against the Wilshire 5000. It's not even going to look close like this. It's going to look as if M1 has just skyrocketed past it, and it's almost as if they can now make the argument that no, it's not a one-to-one relationship, or it's not a tight correlation. It's a completely different thing. That's because they are at a fork in the road. They, the central bankers, they are trapped. What we are witnessing in the markets over the past couple of weeks here, with yields increasing on government debt globally, is causing a panic in the stock market. Now, central bankers are going to tell us that this is because there is organic growth. All of their policies, in conjunction with fiscal policies at the federal government level, are working. They are generating growth. And thus, these bond yields are rising because they are starting to price in economic growth. Hogwash is what I say. I say the bond market is finally catching up to the inflationary expectations. That is not a good thing, because aren't stocks supposed to be growth vehicles? Well, if the economy is growing, then aren't stocks supposed to benefit from that? Well, if yields are growing because there's growth, then why aren't stocks going up along with it? Now, this could be just short-lived. Central bankers are very likely going to come in and attempt to counteract some of this increase in yields. And that might be more juice. That might be more liquidity that further elevates stock prices and thus valuations. That remains to be seen, but it's something to pay attention to. Because once yields continue to rise, despite the measures and policies taken by federal governments and central bank authorities, that's the market saying, we no longer believe you. We no longer believe that these policies work or can work, and that's going to be game, set, match. It's going to be over. Look out below. Next up, we have the Federal Reserve's balance sheet, again against the Wilshire 5000 index, and you can again see this close relationship. I'll sort of break us out here instead of looking back over the past 20 years, just to get at a closer picture over the last 6, and you can see how this moves pretty much in tandem as well. And you can start to see now, after the COVID-19 lockdowns and restrictions and this just massive $3 trillion jolt of an increase with respect to the Fed's balance sheet, is having a huge impact on stock prices. And that's exactly what we just witnessed with respect to M1 money stock as well. And then same thing, Federal Reserve's balance sheet against the actual price, and you can see how close these things move together. So the question becomes, if this balance sheet continues to increase, and we believe that it will because the Fed remains committed to purchasing another $120 billion per month through the remainder of this year of treasuries and mortgage-backed securities, well, then we're going to talk about a Federal Reserve's balance sheet north of $8.5 trillion. And if we continue to see further fiscal policy get passed in the tune of $100 billion, several hundred billion, trillions of dollars, then you're likely going to see the Fed's balance sheet around $10 trillion, maybe even higher. And so now you have to start asking yourself, what's the relationship, what's the ratio between the Fed's balance sheet, M1 money stock, and where the Wilshire 5000 or the S&P 500 is going to trade at? And that's going to be the discussion of a subsequent capital economics presentation. But those are the things to think about. And so when I tell you that charts are going vertical, this is what I'm talking about. When I talk about the markets being hooked on liquidity, this is what I'm talking about, and this at least allows you to see it visually. So that's it for this round of capital economics presentation. I hope you enjoyed it. I hope it was informative. Go back, listen to it again, pause it. The data is sourced. It's from the Federal Reserve itself. You can find this data easily. There's no subscription. Don't have to pay for it. You're paying for it through your tax dollars. This is something that the Federal Reserve throws out there, and that's at least a good thing about them, that we have this data readily available to us. And always check us out at thecapitalnews.com with our daily podcast. And of course, you can find us on LinkedIn, Twitter, and our YouTube channel at thecapitalnews.com. And we hope you do. I am Alex Koritis. Godspeed.